In this video we are going to talk about top penny stocks that pay dividends. So before starting this video, please like this video and subscribe to our channel for future updates. The $377 million Masabi Trust, ticker MSB, a steel royalty trust paying a 4.8% dividend and up 105% in the previous year, is our first penny stock here. Masabi is a remarkably straightforward investment. Cleveland Cliffs has a royalty in mines managed by North Shore Mining, a Cleveland Cliffs subsidiary. North Shore mines the ore, processes it into pellets, and ships it to Cleveland Cliffs, where it is sold. Masabi receives royalties based on the sale price. Masabi has no operating responsibilities or costs, it is simply a trust that receives royalties. That implies the return will be determined by iron ore prices, which are at multi-year highs but still below the 2008 peak. Goldman Sachs says we may be entering a new commodity supercycle, and if even a portion of the projected $3 trillion infrastructure program passes, I expect prices to skyrocket, and this stock to soar much higher. Capital Southwest, or CSWC, is a $433 million business development corporation founded in 1961 that provides loan, private equity, and venture capital to mid-market and late-stage enterprises. So these BDC's business strategy is that they put a financial hold on mid-sized firms. Small firms can go to their local banks for loan, and huge enterprises can receive bond funding or issue stock on the market. But enterprises with annual revenues of $20 million to $40 million go to these business development corporations for financing and equity investments. Capital Southwest offers a generous 7.6% yield and has a track record of paying regular, supplemental, and special dividends. It was able to maintain regular and additional dividends even last year. The company's stock has risen 140% in the last year, and the average debt yield on its loans is 9.9%, which is something you should always verify when investing in BDCs. Because the dividend yield is your gauge of dividend sustainability, you'll want to compare the company's weighted average loan yield, which is 9.9% in this case, to the dividend yield. Is the amount collected by the corporation greater than the amount paid out? Shares are currently priced at 1.39 times book value, making it a little more costly than some of the other financial companies on the list, but with a strong dividend and price return. With a lot of these, you'll hear me mention the price-to-book value ratio, so let me explain why. Most of you are more familiar with the price-to-earnings ratio, which compares the price per share paid by investors to the earnings per share generated by a company. The book value of all their loans and other assets is considerably more relevant for financial organizations, such as these BDCs and banks, thus we look at the price-to-book value for a more accurate comparison. Gladstone Investment Corporation, ticker GAIN, is next on our list of penny stock dividends. This is a $400 million private equity fund that also lends, therefore it fits the BDC paradigm. However, the organization concentrates more on equity investments, with a target of 25% ownership and 75% debt in the businesses it works with. Gladstone has a well-diversified portfolio that spans 28 firms in 13 categories, ensuring that problems in one area or company will not derail the portfolio. The stock pays a 6.9% dividend yield, with annualized payout growth of roughly 2%, excluding the supplemental payments it has been paying. Even last year, the corporation was able to pay both the standard and excess dividends of 21 cents per share. The stock has risen 71% in the last year and now trades at 1.09 times book value. We still have 4 more penny stocks to look at, but I'd like to personally ask you to subscribe to the Daily Bowtie, my free daily market newsletter that keeps you up to date on all the latest stock market news, tactics, and trends. It's completely free, and it's just something I want to do for the community. Free webinar. Learn how to establish a personal investing strategy in just an hour and achieve your financial objectives. In this free webinar, I'll unveil the goals-based investing strategy I designed for private wealth management. Everything you need to know about this simple, stress-free method, step by step. Now is the time to reserve your spot. Penns Woods Bancorp, ticker PWOD, a $170 million regional bank with 27 branches in Pennsylvania under the JSSB and Luzerne bank names, is next on our penny stock list. Penns Woods has a net interest margin of 2.9%, which is marginally below the peer average of 3.2%, and keep in mind that this is a bank's most important metric of profitability. The net interest margin is the difference between what a bank charges on loans and what it pays out on savings, and I believe Penns Woods has space to improve this. The loans to deposits ratio is also lower, at 90%, compared to the peer average of 93%, indicating that there is room to make more loans at a larger profit margin. For those of you who don't know, banking companies are among my favorites this year because when long-term interest rates climb, banks will be able to make more money on new loans. The stock pays a 5.4% dividend yield and has increased by 20%, but it still only trades for 1.04 times its price to book value. Waco Group, ticker WEYS, a $212 million penny stock, adds some variety to the banking and BDC theme. Waco owns the Florsheim, Nunn Bush, Stacy Adams, and Boggs footwear brands, which it sells through its own stores and through other retailers. Florsheim is one of my favorite shoe brands, and with the expected increase in retail spending this year, sales could soar. Waco's stock yields 4.2% and has risen 20% in the last year, but it trades at just 1.1 times trailing sales, which is a fair price for a retailer. LCNB Corporation, ticker LCNB, is a $224 million regional bank founded in 1877 with 33 offices in Ohio. If you've been watching the channel, you'll know that one of the things I'm keeping an eye on in bank stocks this year is the amount the company set aside in loan loss provisions last year. This is similar to a cash reserve account that a corporation establishes in the event that loan defaults become problematic during a recession. The corporation deducts money from its operational profits and places it in a separate account on the balance sheet. What we've found is that loan defaults haven't risen as much as banks predicted. Because all of the stimulus money shielded small businesses from the worst of the pandemic, banks have stashed away billions in this rainy day fund when everything appears to be going well. LCNB set aside about $2 million in 2020, roughly 10 times what it did the year before, so even if it determines it doesn't need all of that money, moving just $1.5 million back to earnings may mean an extra 12 cents per share for distribution. The stock has a 4.24% dividend yield and has risen 62% in the previous year. LCNB is also one of the most affordable companies in the group, with a price-to-book ratio of just 0.93. Union Bank shares, with a market cap of $129 million and a ticker of UNB, is at the top of the list before I share those 3 penny stock dividend traps. Despite the epidemic, UNB has 20 locations in Vermont and New Hampshire and posted record revenue of $12.8 million last year. Loan loss reserves grew by $2.1 million, resulting in an additional 47 cents per share profit if released back into earnings. The stock pays a 4.6% dividend yield and has risen 40% in the last year, despite being one of the most expensive stocks on the list, with a price-to-book ratio of 1.59. Don't click away now. I'd want to show you those 3 penny stock dividend traps since I've seen a lot of people fall for them, and they'll wipe out your profits. Dividend pitfalls to avoid with penny stocks. The first is to just look for dividends with the highest yields. With these 7 stocks, we've managed to balance our dividend cash flow and penny stock returns, but there's a cost. If a firm pays out an 8% or higher dividend, there's a fair chance it's not reserving much of its earnings to fuel stock growth. Management must choose between returning cash to shareholders and investing for the future in every company. With this penny stock list, we've shown that a happy medium may be found for both. Investing just in banks or BDCs is the next trap in our penny stock traps. You'll discover the majority of dividend-paying penny stocks in those 2 areas, either banks or business development companies. If interest rates fall or the economy sinks, investing just in these puts you at risk. Therefore search for different types of business, like we did in the list. This one is a dividend investor's trap. Equities with greater yields solely because their price has dropped. Although the stock prices of the penny stocks on our list have risen, there are still some attractive dividend yields to be found. You certainly must look at a stock price graph here. For example, shares of the Geo Group here appear to be a good buy with a 12% dividend yield until you look at the chart and find that the company has lost 32% in the last year, wiping away your dividend return and then some. The dividend is likely to be decreased since it is unsustainable, so make sure you're investing in strong firms, not simply those with large payouts. What are your thoughts on our video? Please let us know in the comments section below. If you enjoyed this video and would like to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.